Before we move on, let us discuss some special items which normally arise while we are dealing with joint venture problems. One of them is discount charges on bills discounted. Discount charges on bill discounted. In a joint venture, if a bill is received, it may be discounted with the bank. The discounting charges, these expenses are treated as an expense of the joint venture. Expense of joint venture. Normally, a bill would be discounted. It is not retained till maturity in case of a joint venture, since it is for a short duration and all funds need to be collected. So, if a bill is discounted, the discounting charges are taken as an expense of joint venture. Next, if there is an abnormal loss of goods in fire, the goods are lost. The goods will not be a part of a closing stock. Nobody is able to take the goods. The goods cannot be sold. And if abnormal loss of goods is not accounted for, no separate accounting entry needs to be passed. If it is not accounted for at all, the loss gets automatically reflected in the joint venture account. In the joint venture account, on the debit side, all the expenses, the total cost incurred on the purchase of materials has come on the debit side. On the credit side, the sale value has come. If anybody has taken over any material, that is also depicted on the credit side. For the abnormal loss, nothing needs to be separately shown and the loss is automatically reflected in the joint venture. So, abnormal loss of goods in fire, actually there is no entry. Having said that, if there is a loss and there is an insurance claim, then the insurance claim is treated as an income. It is treated as an income. If money is received, it is bank account debit. If its money is received by A's account is debited and the joint venture account is credited. So for an abnormal loss, no entry. Whereas with respect to this abnormal loss, if there is an insurance claim, then that is to be treated as income. Commission on purchases and commission on sale. Commission on purchases and the commission on sales are both expenses and therefore debited to joint venture account We very often make a mistake and assume that the commission on sales is an income. No, commission on sales and commission on purchases, unless otherwise specified, would normally be expenses of the joint venture. The cost of goods taken over. What would be the cost of goods taken over? It is purchase cost plus any direct cost. Taxes paid on the goods purchased, carriage inward charges to bring the goods to the location, etc. All such direct costs for the goods, on the goods, would be taken as cost of goods sold. This becomes irrelevant if the goods are being taken over by any of the co-venturers and it is intimated that these goods are taken over at the purchase cost, at the cost of the goods, or 50% of the total cost of the goods, or 80% of the cost of the goods. So what would be the cost of the goods? The purchase cost plus all direct costs. As for closing stock, usually the venture would come to an end. We ascertain profit and loss at the close of the joint venture and there is no accounting for closing stock. Closing stock is either taken over by one of the joint venturers or it is assumed to be lost. So on closing stock, we don't assume if 10 units have come in, 8 units are sold, we don't assume that 2 units are a part of closing stock. No assumption on closing stock. Meaning if 10 units purchased, 8 units sold, 2 units, no accounting unless specified. Usually the question will say that 2 units were taken over by one of the co-venturers or 2 units were lost. If they were lost, there is no entry. So we do not assume when the number of units purchased and the number of units sold are given. In case of a joint venture, if the joint venture is over, we do not assume that there is a balance of closing stock, since closing stock will be taken over by the joint venturers. Otherwise, it is just assumed to have been lost. So these are some special items. Discount charges on bills discounted should be treated as an expense. Abnormal loss of goods, we do not pass any separate entry for joint venture. However, if there is an insurance claim, that portion of the claim, the insurance claim, is taken as an income in joint venture. Commission on purchase is an expense. Commission on sales is also an expense. Cost of goods taken over. Cost is the purchase cost and all other direct costs incurred in buying of the purchase of the goods. With respect to closing stock, we are not to assume that there is a balance of closing stock. Specific instructions would be given if there is closing stock and what has been done with the closing stock. Usually, one of the co-venturers take over the closing stock. Otherwise, we do not assume closing stock and pass accounting entries, since the joint venture is over and closing stock cannot be carried forward.